Hello, everyone, and welcome to this afternoon webinar. Today is Friday, and my name is Theo. For those who don't know me, I'm here to introduce you to your host so you can continue with Jens. I hope everyone is doing great so far. We had the Non-Farm Payroll event. Outcome came out. A bit surprising from the reaction of the price charts, to be honest, but I'm sure you're going to talk extensively with Jens. So just for now, ladies and gentlemen, please make sure that you subscribed on the YouTube channel here. And there are a few important things. Enable also your notification button. I sent you here the YouTube channel on the chat box. Please, if you scroll down here at Trading Spotlight, you will see all the recording webinars done by myself, by Jens, and by Pauls. Jens talks about a series. Makes a series of webinars about fundamental events, myself about trading psychology series, and Paul's about price action. Okay, so you're going to have a variety of understanding that you need about the markets. You need all the three components. That's why we put them out for you. And if you scroll down, you can see more, like we have live trading. I do Monday to Friday live trading, so you can subscribe here if you would like, or you can do it from directly from the website, and you can participate through Zoom. The next one, before I pass it on to Jens, it's the Instagram account. Please make sure you follow us because we put valuable content for traders and investors. And it's a great social platform to be engaged with. All the time, Yen, before he does his webinar, he's done some introduction, so you know what is happening about what will happen in his webinar. Also, myself, I do many reels about market updates and so on and so on. So you can be informed on a single daily basis. Jens, hello. I hope you're doing all right.
Hello, Theo.
How are you doing today? Good?
Yes. So we just had the Non-Farm Payrolls, which were released, and soundly good. I'm kind of surprised, to be honest, because
Me too.
we saw Wednesday, I think, was the ADP data. Wasn't that good?
Yeah,
and so. Well, surprise. Let's see what the market will do out of this. I think this is, in fact, I mean, after Powell on Wednesday, to be honest, I think a much better than expected NFP it's more interesting, way more interesting than if we got a print now well below expectations. So
yes, yeah, true.
So shall I take over? Shall I share my screen?
Please.
Okay, so
okay, great.
There we go. I will just let everyone know where the chat box is. Hello, traders. So, and this is where you can ask all your questions in the upcoming minutes. By the way, let me just take this off here. Yes, as I already said, today we wanna give the Non-Farm Payrolls a deeper look and try to understand what was just released, respectively, what this will most likely cause in terms of the market's reaction, not just right now. I mean, looking at the charts will give you already a good idea of the reaction and why the market likes it or not. If not, we will guide you, or I will guide you through this and then give an idea why the market reacts the way it does. What's of higher interest in, especially in our case, is certainly what can we make out of this trading wise, especially when looking, for example, right now at the S&P 500, we've seen that there was a sharper drop now following on the NFP release. And the question is, in fact, today now into the weekly close, but also into the next week, then can we hold 4,000? To be honest, I'm surprised to have the S&P now trading above 4,000 because the impulse for this move on the upside was mainly due to Jay Powell's comments he made on Wednesday. And now the big thing, or the most interesting thing, he didn't say something we didn't already know. So that's something to probably keep in mind when looking at this current development. In fact, yields didn't react that heavily. I was really surprised to see the market reacting that bullish, and probably we get a complete reversal of this impulse on the upside now after the non-farm payrolls. But let's see. First of all, it's very important to understand that if this is for purely educational purposes, what we will do here, and the thesis we will formulate, and the trade setups probably, which will result out of our research. It's purely educational if we formulate a trade or if we make a trade. Please be aware that if you plan to duplicate it, to copy the trade, that you take full responsibility for everything around this. So you can keep all gains which may occur, but also it could be that I'm completely wrong with my assumption, with my thesis, with the trade itself, and thus the idea results in a loss. If we take any trades, please be aware that there's risk involved when trading these products, and that you take full responsibility yourself. Please make your own research before entering the market, entering a trade. So that's it in regards to the introduction. I think I don't need to introduce admirals any further. I think Theo did already a great job here. So that's why we can skip right away into, first of all, the questions. Why is the employment situation of interest? And then also to understand, especially the current environment, not just the current, but probably also the one which we'll face in the upcoming months, I think. So in fact, clients of mine asked me, hey Jens, what do you think? So inflation is very hot right now. So not just hot in terms of hot readings, but it's also hot in terms of does it affect the market? Do we get to see impulses on the upside, downside? Is there volatility resulting out of the releases? But also the question, is there something else from a market perspective to keep an eye on? And I said, yeah, I think inflation will stay a topic, certainly, and we will get to see higher volatility around this. But I think that rather sooner or later, the employment situation will overtake, in fact, the developments we see here around inflation, because personally, I doubt that the current environment, no, it's not just that I doubt it, but it's more like I think the employment situation will be of higher interest for the U.S. Central Bank, in the U.S. especially then. The employment situation will be of higher interest due to being or having, to some extent, a direct correlation to the economic health, let's say, of the US. That's probably a good way to put it. And given the current layoff we get to see, especially in the big tech sector, so companies like Amazon, like Google, but I'm not really sure. Google, I think is wrong, but Amazon, Facebook/Meta, for example, are all seeing huge waves of layoffs. There's other companies now during the earnings season where this became clear. I think Hewlett-Packard also led off, I think 10%. I'm not really sure of numbers, but it really starts to sum up. We've seen something, even though Twitter is not a public company anymore, but now private after Elon Musk took over. It was a huge layoff which happened there. So he's drastically thinning out the scene there and firing people. In fact, the thing is that we get a quite direct impression of is it really necessary to have that many people working on whatever topic, especially in companies which are focusing on social media stuff. So if you have 8,000 employees and then you let 6,000 people go and realize that everything runs as smooth as possible and probably as never before, well, this is probably also giving an impression of probably it's not, the structure is not lean enough, let's say. And given that, and especially given the track record of Musk in the business world, with building companies of with a market capitalization of billions of US dollar. In case of Tesla, that was a company which was already worth more than $1 trillion USD and will likely become rather soon or later again a company with a market cap of 1 trillion. But also beside of that, the SpaceX, for example. So many companies which he built up. Also the founder, to some extent, founder of PayPal, for example. There was a merger with PayPal and his company X, I think, and also where he got lots of his money from to build then Tesla from, so on and so forth. So very successful business person. If someone like Elon Musk is cutting down the staff, well, this will probably shine a light on other companies, and many companies and especially CEOs will wonder, do we really need that many people to be employed from us? There was already a reaction from I think it was Bob Iger. Bob Iger is the old and the new CEO of Disney after Bob Chapek was fired, probably, so was laid off himself, and Bob Iger took over. And if I'm not mistaken, he sent an email to the Disney employees asking, are you willing to go mad for the mouse, or be mad for the mouse? So really put everything in and make us as profitable as possible, especially when looking at the streaming of Disney Plus, Hulu, ESPN Plus, and so on and so forth. If not, well, you're free to leave the company then. So this is a strong sign which we get here. And it's not just the big tech companies, but it's also shining down to all smaller companies which are probably working in terms of like freelancing stuff and so on and so forth. So what we're currently witnessing here, especially with now hikes in the rate universe, and then the central banks going more restrictive in their monetary policy approach, this is something to keep an eye on. And the developments there, I think they just started. I think this will continue and even accelerate even further. That being said, long thing short, that means that the employment situation will most likely be of high interest in the months to come, in fact. And that's the reason why I think that, especially as of now, it's very important to understand why this matters. This is a quick introduction here on what thinking process is behind this. Just to understand why is the employment situation of interest for us. So if there's confidence in the economy, politics in this case, and that's positive, respectively, it's good, then you usually see, well, we mainly focused here on services. We are really focusing not really on manufacturing, but it's more kind of non-manufacturing. But usually, roughly speaking, you see an increase in orders in factories. In terms of non-manufacturing goods or goods services, you might probably say, well, right now, especially with social media, free speech, the debate around this, in fact, not really knowing what to make out of all the developments we've seen around COVID and the draconian measures which were taken over here. Well, now we are looking over to what's currently happening in China, and we see some, let's say, hypocrites saying, well, this is not the way you treat demonstrations against a zero COVID policy. Well, we probably should remember that it's not even 1 year ago we've seen the same over here in Germany, in Canada, in Australia. So like you're just wondering what's going on there. So you have questions, and this is something which undermines the trust in politicians in general. If there was ever any kind of trust you could have in these people. And this, and in the service sector, then when looking at social media companies, for example, well, it opens the door to the question, well, what will happen to this sector? So will we see some huge layoffs there because there will be huge restriction in terms of free speech? People will leave these companies or have to leave the company, whatever. So long thing short, if the confidence, right now we're talking about non-confidence, but if there's confidence, usually you see an increase in trust and especially employers in this case, or not just employers, but also entrepreneurs, saying, well, I trust in the future, I have a vision, I increase my stake here in this and that company, for example, where let's say I'm willing to take risks, hire more people. There's natural more demand for the product itself because people look in a prosperous future, for example. So that means that more goods need to be produced. Coming back to the manufacturing sector is probably the easiest way to go. And then to say, well, what we usually see is that there will be a natural increase in orders in factories. As a result, you have an increase in industrial production. So then what this means is that companies will meet the higher demand through more investments. In case of investments, we're really talking about hiring more people, because you need to see that the goods you are selling, first of all, they need to be produced. And that means you have to hire more workers. So if you hire more workers, well, it should be clear that you need to make sure that they are compensated accordingly. So you have competitors in your sector, and if you're not paying well, or if you don't treat your workers well, or your staff well in general, well, then you will not get the best of the best, but you have to take what's left, in fact. And first place to go here is to pay them accordingly and compensate them well. So which means you naturally see an increase in average hourly wages. That's interesting, because that means that people have more money to spend. And if they have a job and look into a prosperous future, and there's a solid outlook also from a political landscape, for example, well, people naturally will buy more stuff, invest, buy a house, for example. Let's say, buy a house is probably a very good way to say that, because if you're having a family, and if you have children, and you're willing to, or you look into a prosperous future, well, you're willing to build a house so that your family has a solid fundament to build from. So sending your kids to school, so on and so forth. And that means that naturally more money in your pocket and a positive outlook, confidence in the overall situation, in the underlying economy, will naturally result in higher economic growth. And since you have more money and there are more goods which are produced, and companies want to make more money, and thus they have to hike or raise prices, you will see prices rising, and thus inflation taking up, respectively accelerating in this case, which then means that a central bank is motivated to hike interest rates in this case to avoid an overheating of the economy, or vice versa. Right now, you might wonder, you say, well, we have inflation, and we have also central banks which are aggressively hiking right now, but it's not that we are looking into a prosperous future, and that the overall situation, as I described it in terms of layoffs from companies, where something's wrong here. Well, what we're currently facing is very important to keep an eye on this. Inflation does not equal inflation. So there is demand-driven deflation. That's what we just described. And there's supply-driven inflation. And that's currently what we are witnessing. It's not demand-driven that people are looking into a prosperous future, but it's because there's not enough goods. And there's lots of money which is chasing these goods and driving inflation higher. And that is mainly due to the central bank policy we faced over the last decade. In fact, after the great financial crisis, 2008, with Lehman Brothers going down, and the central banks countering this economic downturn by printing more and more and trillions of USD, JPY, euros, pound sterling, Swiss franc, and so on and so forth. And then with COVID and the COVID pandemic hitting and interrupting the supply chains by locking down whole economies, well, if you don't produce anything anymore, respectively, if you then say, okay, we lift the lockdown you stopped the engine from running. So now you have to make sure that the engine is restarted. This takes some time while you continue to print trillions of dollars to make sure that people can afford their daily livings, because or they can afford their living standards, because they just lost their jobs, respectively. Their company probably went bankrupt, and then you decide to go with, let's say, fiscal stimulus, for example. So you have the central banks printing trillions of US dollar, euros, and so on and so forth. And then you say, as a politician, because people realize, well, something's not going well there, and if I face trouble in my daily life, the person to put my finger to and say, you're a scapegoat here. You are the one who did wrong, or who did something wrong in this case, is the politician in charge. So that being said, means, well, you're handing out presents like these stimulus checks, for example, handing out $1,000 per person. This is what we call helicopter money. You have plenty of money, you really can't, you don't know what to do with the money anymore, and then you start to do crazy stuff, like, for example, buying stocks. It's not that crazy, but in addition to buying stocks, which would probably result in more economic growth, even if the company is probably not the most profitable one, but you're also buying, let's say, non-fungible tokens and buying pictures of apes and that stuff, which is propping up asset prices all around the globe, beside of buying, let's say, NFTs, respectively, pictures and pixels. Well, you certainly also see stocks rising dramatically. If stocks rise and your portfolio grows, what does this mean? Well, you feel richer than you did before. You consume even more. Now, the problem is you have lots of money, or, well, at least lots of money, let's say. You weren't yet fired. So your company still is in play, let's say, or in the game, and has you on the payroll, but there's fewer goods. More money chases because there is supply chain issues or interruptions, because you just lock down all economies around the globe, and then you have trillions of USD, euro, and so on and so forth chasing fewer goods, which means this is driving inflation higher, which is now seeing, especially with inflation and this effect spilling over to goods of daily lives, let's say. Well, you see that people have a decision to make. Well, do I want to live in, let's say, warm conditions, and energy is pushing higher also? Do I want to have food on the table, or do I want to, let's say, invest some of my paycheck into the stock market, let's say? Well, the decision is easy. You say, no, well, nice to have stock, but it's also nice to have something warm in terms of food on the table. Well, if you then, in addition to that, lose your job, and the overall production circle is interrupted, then you see that companies have not just trouble to meet the demand, probably due to high inventories. Let's look at Walmart, for example. But in addition to that, there's not enough people to sell these goods, respectively, to produce them, the new goods which you need then, because you don't have well-educated people who are capable of doing that. So long thing short, the overall employment situation right now is a hot topic, will be a hot topic in the months to come. And especially now, the question is, what can you do in terms of a central bank? Well, the central bank, in this case, the US central bank, is expected to hike interest rates further to, first of all, dampen inflation, which picked up massively. You've seen that. I'm not really sure where you listen from now, but over here in Germany, where I'm located, we have a inflation rate of 10%. And we are talking about a top up right now. So inflation was already higher than that. The same is true for many people in the UK, for example. In the US, we've already seen a peak out. That was also something we could have seen coming, given the developments in the ISM sector, especially, and here in the paid prices universe. But we haven't yet seen this top out in inflation over here in Europe, for example. So In case of the FAT, and that's why we look at the FAT and then take it from there over to the non-farm payrolls today, we already saw quite aggressive rate hikes. So they went for 75 basis points 3 times in a row. They are right now, you can see that here, that's a tool which we call a FAT watch tool. By the way, let me just share the link here. You can check this out yourself. Copy a link, and then I post it here in the chat box. I call this FAT watch tool. Okay. And we will go over there. So I will guide you through this. This is a very fascinating tool because you get an idea on what the future market is pricing in terms of hikes or rate levels here in the future. So up to mid-June, mid-2023 in this case. And what you can see here is that the current rate, target rate is 375 to 400 basis points. And then till June, we expect the Fed to hike another 100 basis points. How we'll get there? Well, we will see another 50 basis points in December. Then we have February with the next meeting, probably 25. Then we have March with another 25, and we have already the 100 basis points. Then we'll most likely see a skip in May, and then in mid-June we'll likely keep on staying here, and then you will see in the Fed Watch tool that in the second half of 2023, market participants are already starting to price in rate cuts from the Fed. Why? Well, because market participants are right now expecting really inflation to probably come down even faster than initially anticipated, probably due to a deflationary shock, I'm not really sure. And then seeing still that the layoffs, which we're currently facing, will pick up steam, momentum, which will result in voices growing louder that the Fed has to cut rates now to deliver cheap liquidity to companies so that they can afford more employees and to avoid a deep recession in the US. That's the long story around this. What does this mean for the non-farm payrolls? Simply speaking, it means if the employment situation worsens, you expect this cycle to kick in faster than what the market is currently playing. So if NFPs come in below expectations, well, you usually naturally expect them to see the Fed probably not even hike as aggressive into mid-2023, but in fact, probably hike by another, let's say 50, probably 75 basis points, skip probably saying 50 basis points now in December, skip the one in February, hike by another 25 basis points in March, then stay pat till June, and then start cutting from there. And already make sure that the market gets a clear sign, well, guys, we have to fight inflation, yes, but we hear you, we see the developments in the employment situation, and that's why we are cutting rates earlier than expected. Respectively, we don't present ourselves as restrictive as we probably need to, given the elevated inflation levels, but at least it's coming down. So that's in fact the thinking behind this. And now let's head over here to Twitter. I initially planned, in fact, let me just, by the way, check the quotes here. Okay. In 3 minutes, we have Wall Street open. So DAX is already trading around plus minus 0 for the day. US equities down over 1%, tech over 1%. Okay. Let's see how the opening plays out and then use this as an further information. Initially, I planned to guide you through how to formulate a game plan for the non-farm payrolls. The problem with that is, that's probably the wrong way to put it. I planned this for a release coming in below expectations. Why below expectations? That has to do with, oh, by the way, I haven't opened yet. Let me just open here. Great source for a fundamental data. It's tradingeconomics.com. You can see hot data set. US economy adds more jobs than expected. So everyone is talking about this right now. And thus it makes sense to game plan this to make sure that you're prepared for such an event, because market participants will react to that. And you will see that in the market usually. And what we can do here is we go over to countries, United States. Yeah, we can find the labor tab there. And there you have the non-farm payrolls. Where do we have it? there. Non-farm payrolls. You can see 263. That's better than expected. You can see it here. So 200,000. What's interesting, certainly, even though it's not significant, you can see here previous 315 was released in the month earlier, 1 month earlier. We came in at 261. That was also updated on the upside. This is not what a recession looks like. So this is really strong. That's long thing short. So if this is a strong data set, well, it somehow counters what we just said or put out as a thesis. We said, well, we expect the employment situation to worsen. That's why the Fed will probably step back earlier than anticipated from hiking rates or continue to hiking rates, which means if we get to see the complete opposite, which we got now, well, that means we don't need to loosen our monetary policy approach because the economy, as of now at least, still strong. So why should we loosen our monetary policy approach? That's why, well, you understand higher yields, or higher yields in this case, is to some, roughly speaking, toxic for stocks. That's why stocks drop. And that's a simple way to describe what we just currently saw. And so coming in above expectation. Now the good thing is, it's not that we are flying completely blind and that we need to wait till this data set is released, but we have a good indication already beforehand with every Wednesday before the non-farm payrolls are released. We have another data set from the United States, so we can compare these two here. And this data set is the so-called ADP employment change. It's the private sector. And unfortunately, you have here this, let's call it COVID crash, which is destroying the overall picture. But if you zoom in, which we unfortunately can't, let me just see. Oh, we can. This is awesome. This is great. I didn't know that. That's easy. That's cool. Let's go for the last. Let's go here for the last 12 months. What you're usually seeing is that there's a positive correlation between these two. Unfortunately, over the last months, there was a sharper gap, let's say. A sharper gap means that, for example, here, especially from 6 months to some extent, the positive correlation between good ADP data usually means good NFPs and vice versa, is somehow a little counter. But usually you have a good indication, which means if ADP comes in better than expected, you expect NFPs to disappoint, to come in better expected too. If ADP disappoints, as it did, then you usually expect the NFPs to disappoint too. So that's something we have already in mind. Interesting enough, we didn't see a reaction on Wednesday on this data set. We then saw the reaction given the comments from Jay Powell, but long thing short, this is how we built our way into this. And if you have then the ADP data set coming in below expectations, and we look here at this sheet, which is the NFP guesses, which means that you have investment banks here, primary dealers in this case, they give out their consensus or their estimate. There's an analyst, and then the Bloomberg, Reuters, whoever is releasing that, is asking the question, hey, what do you think of non-farm payrolls? What's your number for this release? So you probably have wondered why this is of importance. You have probably wondered where this consensus is coming from. Where's 200,000 coming from? It's to some extent, it's an average here of these primary dealers. So they just sum them up. They divide it by the number of investment banks, primary dealers they asked, and then they get an average number. They round it up, round it down, whatever, and then you have a number. And that's the thing you can see everywhere printed. What I'm more interested in is, where's the skew? So, and if you look at these numbers, and this is now taking a little too long, but if you look at these numbers, you will see that most of these, and I think it's 21, if I'm not if I was wrong when counting them, I think 6 came in below 200,000. The other 15 expected to print at or above 200,000 if you closely watch this numbers. and this is interesting now, important, because we're not using this now to formulate a thesis and how to enter the event, because then you can say, well, if the ADP comes in, this surprises here, because usually you expect ADP positively correlated to the non-farm payrolls. Why are primary dealers, investment banks are expecting a print above 200,000? They're probably caught on the wrong foot here with their expectation. The interesting thing now is that this, let's say, skew above 200,000 is probably the reason why the market is not selling off as aggressively as you would expect it after the rally we've seen from Powell. And that in mind, now coming here to the numbers themselves, you can see 263, 200,000 unemployment rate as expected, even average hourly earnings. So they're paying their employees more money on average per hour, coming in twice as high as expected. And given that, this is usually a positive sign. But coming back to these primary dealers here, respectively to the guesses, they came in above 200,000 already, surprisingly, but they came. And now what we have is, this is the S&P now on the hourly chart. Let's go on the 5-minute chart. You can see here, numbers were released and then we sold off sharply. Again, the reason for this sharp drop on the downside is simple. It's simple because, well, the market ran higher into this event. These were the comments from Jay Powell. We won't dig too deep into what he said. In fact, he didn't say anything we didn't already know, at least not for everyone who watches here this Trading Spotlight webinar series. In fact, we covered the Fed and what the Fed delivered, and he in fact said the same. So he repeated what the Fed already delivered at the beginning of November. So saying, well, we plan to decelerate, let's say, or not hike as aggressively as we did in the recent past. 75 basis points, no, but we go for 50 basis points. There will still be a long way to go to fight inflation. He came out with saying, probably we see some kind of soft landing. And all this was something we knew already. So we see this sharp rise higher, and everyone was wondering, why is that right now? I have no idea why this happened, but it happened. And the market was capable of holding these gains from Wednesday into the afternoon, evening here in this case. And so now we come in with the non-farm payrolls, and they are underlying that the dovishness, which market participants interpreted into the comments from Powell for whatever reason, was probably too much, which means we are selling off sharply into the release. But, and this is the thing, again, the market mainly expected a print above 200,000. And this is something I can say because I just had a deeper look here at the primary dealers. So we can see that they came in for whatever reason after the ADP data set, they came in and expected the non-farm payrolls to come in above 200,000, which means we are immediately, no, not immediately, initially we're selling off sharply. We are pushing lower, but we hold 4,000. And now we are bouncing. We're buying this back because the market was expecting that already, was potentially prepared. How do market participants, primary dealers, investment banks prepare? Probably they bought insurance in terms of buying puts, for example, one way to go. And this is very interesting because now we see the sharp drop, but we are getting bought back. Well, we are not out of the woods yet, let's say. So it's too early to say, well, this is good because we held 4,000. Well, let's see what the next hours bring into the weekly close. But the reaction is strong. After the, let's say, flush lower, we saw a bounce, making a higher low in this case, and now pushing back and buying back not all, but at least part of this initial flush on the downside. We have seen other occasions in the recent past. It's a change of character, we could call this. So if you look at inflation data, for example, look at the inflation data we've seen over the last 6 months. It wasn't uncommon, let's say, to see a print higher than expected, harder than expected, especially inflation numbers, flush lower, small bounce, selling off, making new lows, closing at the low of the day. This is a different character. This is a change. you see the flush lower, okay? You bounce higher low, pushing higher, buying back the initial flush. That's something we shouldn't underestimate. Again, too early to call along here, but definitely something to keep in mind for next week. I wouldn't be surprised, especially if we close significantly above 4,000 and above, in this case, by the way, the 200 SMA in this case, which we recaptured given the comments from Jay Powell. I wouldn't be surprised to see another attempt towards 4,100 in the next days, and with a break higher, then a push up to 4,160, probably 4,200 into the Fed, which will release our statement and monetary policy decision in 1.5 weeks from now. So next week, and then next week, Wednesday, so 14th of December, they will release that data set. And it's a packed agenda that week, because already on Tuesday, we have inflation. If inflation comes in further and we react to this data print here from the non-farm payroll strongly, and inflation cools down, and the Fed's, let's call it pivot, they pivot to some extent, and they make clear, well, we will probably hike beyond 5%, but don't expect us to hike more aggressively beyond that point. That could trigger a sharp rally, especially after the market came off quite heavily over the course of the last 12 months. By the way, if we say pivot respectively, if we use a lingo like that, let's come to the Fed watch tool. I promised you to have a look here. Let me just update it. By the way, I want to have a look at the stock I'm closely watching, which is Tesla. Tesla is strong. Tesla's great. Unfortunately, I don't have a real-time chart, but watch one. Not really sure if it's 193. I think we already recaptured that level. Trading above WeWeb again. This is strong. So if we get to see another flush on the downside in Tesla holding 193, I wouldn't be surprised to see a stint up to 200. So if you're looking at stocks, especially, and plan to day trade stocks, then watch now 193, which currently I can see here WeWeb volume weighted average price coming in at 193.56. We have delayed data, so that's the reason why I don't show you Tesla here, because it doesn't show us anything, because we have a 50-minute delay in this case. So this is not updated as of now. So in 5 minutes, when this webinar ends, and this doesn't make sense, we already saw the flush in the pre-market below 193, and now we're making it back above that level. This is very strong, and again, holding 193, I really expect Tesla, especially if the overall market performs solid, let's say, Tesla is good for a stint up to 200, probably 202. But coming back from here, having a look at the Fed Watch tool. So what we have here, so this is the link I just shared in the chat box. And by the way, if you watch the recording on YouTube and you're interested in this link, please let us know in the commentary below this video, so we can easily share this. This is free of use here, so it's not free of use. There's no cost involved. It's just an official site from the CME here. So Fed Watch tool. December, still 75% expecting, and this is surprising to me, to be honest. I don't really see why 25% are still expecting the Fed to hike by 75 basis points, but whatever. So markets with a majority expecting the Fed to hike 50 basis points here, 3/4, so 75%. If you go to June, you get the same. By the way, this changed. I took this screenshot before I started the event. Now it changed because of the print, non-farm payrolls print was just released. So the market is now a little more hawkish, but only slightly more hawkish, which is also a change in character. It's not that the market is now pricing in a deep rate hike above or beyond 500 basis points here. This is also something to keep in mind. And now, keep this in mind. So we just formulated already a path up to 500 basis points in the first half of 2023. Let's go to December. And if you look at these columns here, you can clearly see that the market is expecting rate cuts from the Fed in the second half of the year 2023. And this is exactly what I was talking about when I said, well, the employment situation is likely to worsen, and the future market is anticipating that. It's already seeing the Fed to cut in the second half. And the question is not if the Fed will cut, but when the Fed will start cutting rates, in my personal opinion, at least, which means this is something to definitely keep an eye on. And if the inflation starts to cool down more aggressively, quicker than we anticipate, respectively, the situation in the employment sector didn't worsen today, but it's likely to worsen probably next month, next 2 or 3 months. This is exactly what market participants will look at, and the macro guys will look at in this case, which will definitely affect yields, which will naturally affect then these columns in terms of the future market and the Fed watch tool. And if we start to price this out, usually this is bullish for stocks. So this is usually something where you expect the S&P, DAX, probably in the shadow of the S&P, the NASDAQ, tech stocks especially, to perform really strong then. And so let's come back to the S&P. Where do you have it? There. So again, we are not out of the woods yet. Again, I'd like to see a close significantly above 4,000 and above the 200 SMA. But after that print, and if we're capable of making back most of the losses we've seen, or the drop we've seen in the pre-market of Wall Street, respectively, with the release of the non-farm payrolls, if we're capable of making most of these losses back, and the S&P pushing, let's say, above 4,050, 4,060 points, closing above that level, this is something I really consider to be really, 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 really strong, and something to keep an eye on, because it makes it likely that we will push above 4,100 in the next week. By the way, we mainly exclusively talked about stocks, respectively, indices, equities in this case. Some of you probably are also interested in gold after the recent run. So we saw a heavy reaction now against 1,800. You can see that there. But we are about where we saw a bottom forming. Keep an eye at this area, especially 1,000, probably 805. So you can see here, that was the highs from August around. We now bounced heavily, because if yields spike, the Fed is likely to be more restrictive. This is counter bullish, or this is anti-bullish gold, let's say, put it that way. The interesting thing now is this is a potential breakout level on the upside. This is the first trade breakout level, especially for short-term traders, very short-term traders, also momentum scalping traders, momentum breakout traders. So 1,805 is definitely a level to watch. I have an alarm at 1,800 probably to realize, okay, we are about to enter a hot zone. Let's say if we get to see a break higher, momentum is likely to occur, and it could probably be a very sharp run higher, especially if it's triggered from another fundamental macro trigger like the Fed. Also, if you plan, or if you wanted to wait after the recent run higher, this is also an area you want to keep an eye on in terms of going long against. So if you plan to trade on retracement and find a solid support, I think the area we're currently trading in, 1,780, 1,785, is probably worth to keep an eye on. It's very, very interesting to watch this level and probably trade gold long against, with the target then of trading a break higher. What we would do is, in fact, we build a position against this area here as a core position, and trade then still the momentum with a drive above that level, but keep this position here as a core, expecting more bullishness in gold to happen. Also, given the fact that we are about to enter a very bullish seasonal window into the end of the year, second half of December and the first month of the year, first month of the year, January in this case. So 1.5 months in front of us is probably very bullish for gold, especially from a seasonal perspective. So this is something to keep an eye on, and which we could also use as a potential driver higher in gold then in this context. So Tesla coming in now. So I have the chart here. You probably wonder. So this is a real-time chart with Nasdaq data in this case. So we're coming in here. Let's see if we can hold again, if we can hold the volume weighted average price respectively. If we can hold 2-minute chart probably. If we can hold VWAP here in this case. So this is definitely something worth to keep an eye on. And if we hold 193 or flush below, quickly rebid, and then push back above the volume weighted average price, again, things are getting interesting for Tesla on the upside. I could imagine this short term very interesting with a stint up to 200. But first of all, we need to see that we are holding 193. That's it from mine. So I hope you enjoyed this webinar. And again, if you have any questions, please feel free. This video will be uploaded on the YouTube channel from Admirals. So if you have any questions, feel free to put them, post them in the comment box below. And I'd be more than happy to answer your questions. Talk to you again next week, and happy trading. Have a nice weekend. Enjoy yourself. Talk to you soon. See you. Bye-bye.